John Taylor coming at you with another video about the merger and acquisition investment banking process. So I wanted to show you, basically, this was a sale we did of a business. This was actually a couple years ago, a logistics company based in California that we sold to a private equity firm. And wanted to show you how we stacked up a number of private equity offers. So we went to the marketplace, contacted several hundred private equity firms and shown them financials, kind of the offering document on this business. This company did about $5 million in EBITDA, and then collected those bids from various groups. So here we have, as you can see on the sheet, 11 different bids from different private equity firms. Some of them had holdings in the industry, others did not. But so basically the way we stacked up these offers, so this first column here, we lined up the valuations. So most of the bids came in at 5 to 6 times EBITDA. And then the cash consideration, because so the valuation of the company is really the enterprise value. So that's the offer. You can think of that as the purchase price of the business. But not all of the considerations necessarily going to be in cash. So we break out the cash portion of that compensation. And then in some cases, they had other considerations. So in a couple cases, we had earnouts were offered. That's basically where the buyer says, "Hey, I'm not going to pay you cash up front, but as after we buy the business, we'll pay you additional cash out of the income of the business for the next 2, 3, 4, 5 years potentially." So we had a few groups offer an earnout consideration, and then a couple groups offered what's called the seller note. So that's basically telling the seller of the company, "Hey, I'm not going to pay cash right now, but what I'll do is I'll give you basically give me a loan of, say, $2 million or $3 million, and I'll pay that off over 2 to 3 years." So, I mean, obviously there's some risks when someone sells their company for anything other than cash, because, if the company has trouble in the future and the buyer's unable to pay that debt off or pay earnings out of the business, then that could be money that the seller's never going to see. So the next column here, rollover, that basically is the percentage of the company that the buyer wants the current seller to retain. So in this first case right here, they're asking for 15% rollover. So they want the existing seller to say, "Hey, you retain 15% of the shares going forward. We're going to buy 85% of your shares. You keep 15% of your shares, and you're going to own that going forward." So you're basically going to be a minority shareholder in this company that you used to own 100% of, but going forward, you're just going to be a small partner. In some cases, one group was asking up to 30% potentially of shares he wanted to roll over. I mean, in this case, the seller did not want to roll over any shares. He wanted to sell 100% of the company and just move on, because he felt that, look, if I'm not going to be the majority owner, being a minority shareholder, you've got limited rights. You can't make control or management decisions. You basically have to do what the majority shareholders want to do. And so, understandably for those reasons, he didn't want to be a minority shareholder. So if he says, "Look, if these guys want to buy the company, they gotta buy 100%, because I just want to be out of it if I can't be in control." So this next column, stock. So there's different types of sales. You could either do a stock sale or what's called an asset sale. So the key thing to understand in a stock sale is that if you sell the shares of your company, or if someone buys the shares from you, basically they're also buying all the trailing liabilities. So if a customer comes back and sues the company for something that happened in the past prior to the point in time they bought the company, they're going to go after whoever owns the shares today. Whereas in an asset sale, basically the company and the shares stay intact and are retained by the existing owner, but a new company comes in, they set up a new company, call it Newco A, and they purchase just the assets out of that business. So that they'll purchase the customer contracts, they'll purchase any equipment, they'll purchase the leases and any other, the employee contracts, independent contractor contracts. So basically, in obviously the trade name of the company, and any other assets that they have. So in an asset sale, there's a different tax basis. So there's kind of tax advantages to an asset sale versus a stock sale. Usually, a stock sale is more tax advantage. So the seller's going to pay less taxes on his proceeds, and also he's not going to have trailing liabilities going forward. But an asset sale, usually a lot of buyers like to just purchase the assets because they're not going to have those trailing liabilities. So if something happened in the past, they're going to sue the seller. They're not going to come after the new owner of the company. They're going to go after the old owner. Escrow. So escrow in this next column, basically that means the percentage of the proceeds or the purchase price that's going to be held in a bank account or escrowed for a certain period of time. Say it might be a year, 1 year, 2 years, 3 years. And basically what that does is that if there are any claims in the company going forward, like if there's a lawsuit or if there's any, if the seller kind of misrepresents anything about the business, there could be claims against that escrow. It basically gives the buyer of the business an opportunity to go back and claw back some of the purchase price if anything was misrepresented in the sale, or there are any kind of liabilities going forward that come back to hurt the existing buyer, the company. So it's like a security account that's held there to pay off any claims that might be going forward. The next column, closing, this is the number of days that the buyer expects that it will take for them to actually close the transaction. So they're going to sign what's called a letter of intent to purchase this business on day one, and then they expect that they're going to go through due diligence, they're going to audit the company, they're going to bring in accountants and perform an audit, they'll have attorneys go through legal due diligence, they'll look at contracts, any lawsuits or other outstanding liabilities of the company, they'll do a market analysis, they'll hire consultants to do a market analysis and make sure that the market opportunity is there, they'll make customer calls and make sure the relationships are still good. But this last column here represents the amount of time, anywhere from 60 to 90 days, or I guess in some cases, one group was asking for 120 days to close. That's the amount of time it would take them to close the transaction, perform their due diligence process. And the closing is where money changes hands and a purchase and sale agreement gets signed. So those, they don't necessarily happen on the exact same day, but in most cases that's the way it works. You're looking at a significant amount of time there, right? Because even though the seller might be signing this letter of intent on day one, he's actually not going to get paid for 90 days. Or, the deal may not happen at all because they could, during that due diligence, that period, they might discover something that was unforeseen or they didn't know, or they just decide, hey, we don't like this business anymore, and they walk away. So that's the risk that the seller and the buyer takes when they sign a letter of intent. And of course, the buyer, they're going to be spending hundreds of thousands of dollars on that due diligence. I mean, they're going to pay, I think in this case, on this deal, the buyer probably paid their attorneys well over $500,000 just to look at contracts and analyze a bunch of things about this business. So they're spending a lot of money and want to see the deal close because, they're going to be out of that money. They pay a couple $100,000 to perform an audit on the company, and the deal doesn't close. Those are transaction costs they just have to eat, and they're not getting the benefit of owning this company going forward. So anyway, that's kind of how we stack this up. This was a deal we ended up closing, and we actually got more money in the end than what was initially indicated here in this document. So anyway, I thought this was interesting. I hope you find it interesting as well. Thank you very much.